First, we start off with the World Cup of pain. It's not a win for the global markets. Around the world, some of the largest markets are struggling over the past month. Brazil down a whopping 16%, with China, France, and Germany all under pressure. And just like the U.S. is sitting out the real World Cup in Russia, the S&P 500 up 2% in the past month. But that could be trouble, too. Check out this chart. Since the Fed raised rates and said there would be more ahead in 2018, we have been under pressure, down more than 400 points since the highs of that day. So is today's selling less about the trade war fears and more about the global sell-off? And is the U.S. heading for more pain ahead?
Two-part question.
Two-part question.
Let's go! Don't you like that?
Yeah, that was good.
Yeah. They're going to play that all show. So if you want to change the channel, now's the time to do it, folks. I think the short answer is I don't think today was about tariffs. You know, last Tuesday night, we played a game, Hawk or Dove. It was like the Neil Young album. And you asked him, he said hawkish. You asked me, I said hawkish. But the AT&T Time Warner deal should sort of supersede that, and the market will be fine. I was wrong, but I do think the market's concerned that maybe the Fed put is not in place. Now, I don't want to get crazy because the market hasn't done anything catastrophic and the VIX is still south of 13. But I do think that Fed put that everybody has relied on for the last 8 years is no longer there.
Yeah. Well, I don't think it's a major surprise. In fact, what he said in that press conference was, I think the economy is great. And yet we're still 4 hikes away from neutral Fed funds rate. So if you think about it, there's still a lot of Fed in our future. And yes, I think that's reason to be concerned. Having said that, again, the economy is in great shape. So the question is, are we now truly the strongest player in the World Cup, which we're not even in, by the way? And that's a metaphor, folks, because I know that. But there it is. There it is. But the problem is, if you look around, you know, emerging markets, which is certainly an asset class I cover a lot, I think you've got some breakdowns, idiosyncratic, that I don't know has to mean you're seeing a global breakdown. I think bottom line here is EPS is what it all comes down to, and I think it's not bad.
A higher dollar is also playing into all of this.
It is, but you know what? I would say the higher dollar for right now is actually a sign of being pretty positive, right? Because what you're seeing is all the money coming from the periphery, emerging markets, Europe, all of that, coming back into the U.S. So we could be in a period where you start to see a higher dollar, lower bond yields, because people want to buy our bond yields because they yield more than the rest of the world, like Germany, and higher stock prices. It could be, it's kind of a weird scenario, but if we are the best economy in the world, then all the assets should come here. 6 months, 12 months, 18 months down the road, yeah, be concerned about what's going on in emerging markets. But for today, I think the market's told you everything you need to hear.
Well, I think it goes back to what you guys were talking about, emerging markets. You know, back in the summer of 2015, the world was really concerned about the health of China's growth for all intents and purposes. We had some major risk asset volatility in August of 2015, in the first quarter of 2016. A lot of it had to do with the fact that how fast was China growing. When you think about what's going on right now, so yes, our growth, people are projecting above 3%, maybe 4% this quarter. And when you think about China, it's literally been stuck at 6.8%. If these trade tariffs, if this turns into a war, I think the question becomes what happens to China's growth and what does it do for the rest of the globe? And I think that's one of the things why maybe our markets are kind of just churning a little bit here. And we're seeing some weak data. I mean, Tim, you saw the retail sales in China last month was the slowest pace since 2003 when they had the SARS outbreak. So these are the sorts of things I think it makes sense as we get into summer to keep an eye on.
I think that's right. But I think China right now being stuck at 6.8, 6.9, their industrial numbers are effectively near 3-year highs. If you look at China and their demand on commodity prices are near 4.5-year highs. We haven't seen copper fall out of bed. Oil's right near the highs. Metals prices are right near the highs. Record lumber prices we talked about in closing bell. You have steel prices at record highs. So if the world's coming to an end here, shouldn't we see, or if China's about to fall down, I don't think we'd see this.
I don't think we're saying that the world's coming to an end at all, but just on a relative basis.
But you have to ask yourself, we're this far into the
World Cup. Anybody know it's World Cup week?
Really?
You know what the best part of the World Cup is, Tim?
Don't hear it.
What?
Don't hear it. There it is. Thank you. Stop.
Dan saying stop. Now it's Salty Dan right off the top.
Why not?
BK was saying something.
I was saying something. What I was saying is that the world doesn't have to fall apart, but you can say that, listen, we're so far into this economic cycle, we're so far into this recovery, it would be very natural to have another correction, be very natural to have a slowdown in the economy. But I do think you need to be concerned about China. I mean, some of the stuff that's going on there are major companies that have gone bankrupt. We don't hear about it a lot because they've simply papered over it and put state resources towards it. But if that continues, that can be a problem. It's not not today, though. The market's already told you. Listen, it's going up here in the U.S.
Trade war also, let's be clear, this is not going to hurt these economies right out of the gates. It's hurting sentiment. Yes, you hear about it in a housing survey. You hear about it in regional Fed surveys. But, and Brian didn't just say this. And so here's the point. China is not about to fall out of the sky. And the people, the China bears and the doomsayers in 2015 have been so wrong for so long.
Well, Tim, why did the Shanghai Composite close at a new 52-week low on Friday? Why is it down 15% from its 52-week? I'm not calling doom and gloom. I'm just saying, like, if we're looking for things that are
that market trades on liquidity dynamics. They've been reeling in some liquidity. They've been targeting certainly excesses, and I think it's highly speculative. I don't think the Shanghai's ever been representative.
Doesn't that have the potential
economy.
to make economic conditions tighter? And so we started out talking about what are the potential effects of a tit-for-tat trade skirmish going into something broader.
They're not good, and they're affecting sentiment right now, and I think that's ultimately what we're saying. But I think China is in a much better place either in the industrial side, on the retail sales side, than they were 3 years ago. And frankly, I think the global economy being stronger helps China more than it helps us. I think it helps emerging markets more than it helps us. So maybe that's the indictment we're saying.
So we started the conversation, is it more China? I still think it's more Fed, the U.S. Fed specifically. I'm not certain the Fed put us in play. I understand the headlines about China. That's important. But I do think it's all about central banks.
It's not even close to it. I mean, so I'm agreeing with you and saying, take that out of the story. The Fed put is gone. That's the big thing here. For the last 8 or 9 years, we've had every central bank in the world throwing liquidity at us. This is why this market is supposed to struggle here. This is why this market is not ridiculously cheap.
Because we have risk to the downside when it comes to growth around the world, effectively, right? We've got a higher dollar. We've got a Fed that's still in play and a Fed that doesn't want to hold up the market.
And we've got a NASDAQ at all-time highs, and we've got the Russell at all-time highs. I mean, what are we talking about? It's not like the market fell apart. We're down 50 basis points today. And we've got all-time highs in a lot of stocks.
So what are you doing here? What are you doing here?
Stay long.
Swapped his bear suit. I mean,
I know, in a big way.
Listen, I'm predisposed to be bearish, but the market's telling me that it wants to go higher. And by the market, I mean the U.S. stock market.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.